Nigeria's central bank has kept the benchmark interest rate at 11%, its governor, Godwin Emefiele, has said. Emefiele said the 12 members of the bank's Monetary Policy Committee voted unanimously to keep the bank rate unchanged. The bank also held the cash reserve ratio for commercial banks at 20%.
The committee noted that at its November 2015 meeting, it eased monetary policy with a view to increasing the liquidity of the banking system. This was aimed at moderating domestic interest rates so as to encourage indigenous businesses to borrow. While the objective of stabilizing the financial system in the aftermath of the Treasury Single Account, TSA withdrawals, and JP Morgan delisting of Nigeria have been largely achieved, the goal of increasing lending to key sectors of the economy is yet to be achieved as the bank continues to adopt moral suasion to encourage the deposit money banks to support financing for targeted lending to the real sector as well as agriculture, solid minerals, and small and medium enterprise sectors of the Nigerian economy. Despite current challenges, the committee remains guided by evidence underpinned by credible data in its holistic evaluation of the emerging scenario and in its assessment of policy choices. Consequently, the committee believes that given sound and properly coordinated monetary, fiscal, and external sector policies, there is wide room for optimism about the medium to long-term macroeconomic prospects for the Nigerian economy, especially given the clarity in the policy direction of the administration, the various interventions in the rail sector, gradual improvement in the power sector, and the reinvigorated fight against corruption. The committee also believes that the effect of softer monetary policy stance adopted in the last MPC should start crystallizing soon through expansion of credit to critical sectors of the economy. In addition, the unveiling of the federal government budget oriented towards social, economic, and infrastructural development is expected to provide the necessary impetus for growth. The committee acknowledged the continuous liquidity surfeit in the system, stemming partly from the recent growth-stimulating monetary policy measures, as well as the tendency of the banks to invest excess reserves in government securities rather than extend credit to the needed sectors of the economy. To this end, the committee once again urged deposit money banks to improve lending to the real sector as part of their patriotic obligations to the country, and enjoined the management of the bank to continue to explore ways of incentivizing lending to employment and growth-generating sectors, particularly these SMEs. Monetary Policy Committee also emphasized the necessity of coordination between monetary and fiscal policies as prerequisite for resolving the nation's economic problems, particularly steering the economy away from oil dependency. In particular, the committee stressed the need for the fiscal authorities to complement the bank's low interest rate policy orientation by properly coordinating its borrowing activities and rates with the bank in order to push the common objective of stimulating banking system credit delivery at low interest rates to the key sectors of the Nigerian economy. It noted that given the current economic reality of dwindling oil revenue and a rather unclear outlook for commodity prices, there will be need for a recalibration of the fiscal strategy to increasingly explore opportunities in non-oil tax revenue. Finally, the committee reiterated its unyielding commitment towards achieving a stable exchange rate regime to ensure more flexibility for sustainable, inclusive economic growth in the medium to long term.